Today, Andrew Bailey, the Bank of England's governor, kind of like the Fed's Powell, said, "You have 3 days to sell all things." Was he talking to the global markets, or was he talking just to the pension funds that they are trying to bail out by buying back their bonds? So I'm going to explain what the whole problem is with the UK and the pension funds and the bailout. And I'm going to talk about his comments today and the effects that they had on world markets, stock markets, bond markets, the dollar, all of that. Also, does the US have the similar problems as the UK pension problems? And can these problems in the UK bond market seize up the whole world financial markets? A lot of people are starting to think so. So let's start at the beginning with the UK pension problem. Pension funds know that they have to pay out a certain amount of money in 1 year, in 5 years, in 10 years, based on the liabilities that they have of people retiring. To do that, they have to take the pension fund that they have and invest it in such a way that they have the money to meet those liabilities when they come due. The problem is that most of them are actually underfunded based on the returns that they are getting right now. Now, they know that they're underfunded, but they may project that, hey, we're going to make 8% a year for the next 20 years, and so technically we're funded, but they're really not making those kinds of returns. But with bonds paying almost nothing for many years now, they are trying to play catch up. And the way they are doing that is by doing riskier and riskier things, including using a lot of leverage. With some pensions even leveraging up to 7 times of their actual money. And the problem with interest rates that have been falling all of these years is that lower interest rates means they need more money today to pay for those future liabilities in the future. I'll show you on an actual calculator, but think of it like this. If you have to pay off $1,000 in 1 year and your rate of return for the year is going to be 0%, well, then you need $1,000 today to pay for that $1,000 in a year. But if you needed to pay $1,000 in a year and you could make 100% on your money in 1 year, you would only need $500 today, right? So let's say the pension fund needs to pay out $1,000 in 20 years from now, but their return that they're getting on their investments is 10% a year. How much do they need now, today, to pay out this $1,000 20 years from now? Let's see. Okay? They only need $148 if they were making 10%. Right? What happens if they are only making 5%? Now they need $376. And what happens if they're only making 1%? Now they need $819. So you see, as interest rates go lower and their yearly return goes lower, they need to have more money today to pay for these liabilities in the future. So because of that, a lot of these pensions started buying these products called liability driven investments, or LDIs, sold by firms like BlackRock and others. It's a little bit like those target retirement funds where you say, I'm going to retire in 25 years, and you just put the money in and they rebalance it and all of that kind of thing until you're going to need it. Except that these funds use leverage up to 4 times. Now, leverage increases your risk a lot, and these pension funds are supposed to be investing in very non-risky things like UK government bonds. So think of it a little bit like you're trying to get to work, let's say, and normally it takes you 30 minutes, but you get stuck in traffic for 20 minutes. That's like the low interest rate environment. What do? When you get out of that traffic, now instead of driving 50 miles an hour, you drive 150 miles an hour to make up for that lost time in the traffic. Well, what does that do? Of course, that is very risky and increases your risk of a crash a lot. And that's what's happening to these UK pension funds right now. And what kicked off this crisis was the government proposal that they were going to do away with the top 45% tax rate. And this is at a time when they are trying to fight inflation. And the Bank of England is doing quantitative tightening by selling bonds, which they have now reversed course to bail out these pensions. So that tax proposal scared the bond market and long-term bonds sold off and those interest rates went up. So why was that a problem for UK pensions? Well, these pensions had swaps that swapped the interest on long-term bonds for the interest payments on shorter-term bonds. As longer-term bond yields rose, the pensions had to pay out more money to the swap issuer, and at the same time, the bond price went down. And so, since it was leveraged, they had to put up more collateral. So, how do they pay for this margin call? Well, they have to sell other assets, which can mean stocks or other government bonds. So, as they are selling off government bonds to meet the margin calls, well, as you sell bonds, the price goes lower, the interest rate increases, which makes the pain even worse for them because then they get bigger and bigger margin calls. It's kind of like a death spiral. So the Bank of England has now reversed the quantitative tightening of selling bonds and is now bailing out the pensions by buying up to $65 billion in bonds until Friday, October 14th. So, what did the Bank of England governor say today, and how is the market reacting, and what kind of spillover will we see from this? Let's take a look. So, Bank of England says you have 3 days to sell all things. And while he was making this comment that spooked the market, the IMF was also slashing global growth outlooks and more hawkish comments from the Fed, refuting the not so hawkish comments from another Fed member yesterday. But while Powell is trying to calm the markets, telling everybody inflation is transitory for a year until he admits it slowly but surely, this guy from the Bank of England is trying to scare everybody, it seems. So he spoke in Washington today, and he was initially warning that market volatility went beyond bank stress tests. In other words, those nice stress tests that they do to say if this bad thing happens and that bad thing happens, can the banks withstand the stress? And normally they always come out with flying colors until something real happens. He's already saying that the banks cannot withstand this market volatility. And he said that there's a serious risk to UK financial system stability, noting that the buying program is temporary. And so this is what really spooked the market. My message to the funds involved and all the firms is you've got 3 days left now. You've got to get this done. The essence of financial stability is that intervention, is temporary. It is not prolonged. So Zero Hedge paraphrased for him, basically saying, you have 3 days to sell everything. And that doesn't just mean pension funds, it sounds like. So to stop this huge rise in interest rates, the Bank of England intervened over here and the rates dropped down to like 3.6%, but now they have crept back up. And they also added inflation-linked debt to their purchase program. So, but it seems that traders are reluctant to offload large quantities of gilts, which are UK bonds, because of the Bank of England's approach to making purchases. So basically, the central bank only bought these bonds that were close to the prevailing market level and has rejected offers it deemed too expensive. Meaning they're not going to buy bonds at any price. They're buying them very close to where the market is trading. So they're not trying to bail out the price that these investors paid for these bonds by overpaying what the current market is. So investors may get a slightly better price by selling their bonds to the central bank rather than the open market, but the difference is measured in small fractions of a percentage point. So basically, they have to put in these offers that are very close to where the market is trading and hope that the Bank of England accepts their offer. In the meantime, while they're waiting to hear back about the offer, the actual market could be moving against them in the meantime. So this is different than the QE programs they did after the financial crisis, the Brexit vote, and the COVID outbreak. Back then, they bought a predetermined amount of bonds, whatever the price, with the express intention of lowering yields. They're not doing that this time. So they said they have no intention of seeking lower bond yields. And so they're saying the pension funds would rather sell riskier assets, including corporate bonds or property. Usually, when things are going bad, people sell the riskiest stuff first and hold on to the safer stuff. And so the British pound fell a lot on that from about 111.5 to under 110. And so S&P futures, the Dow, the Russell, and the Nasdaq all fell on those comments here in this red section. And 10-year notes were up earlier in the day, hitting that 4% level, and then the yields sold off on those comments. Essentially, this drop in yields after his comments is because investors were buying up 10-year U.S. Treasury notes as kind of a flight to safety of what's going on in the UK and other places. And so just on those comments, the Fed terminal rate expectations, meaning how high they think interest rates are going to get in this raising cycle, fell a little bit, as well as the subsequent rate cut expectations that they expect for next year also fell a bit. And the dollar, which fell earlier in the day, rallied almost back up to the previous highs after those comments. Again, flight to safety. And so people are thinking that a lot of market participants are starting to panic. And here's an article saying that the Fed quietly sends $3.1 billion to Switzerland via a swap line, and that was most likely for Credit Suisse. And so this Bank of America strategist said, markets stop panicking when central banks start panicking. And Mohammed El-Arian, who used to run the PIMCO bond funds, is saying that the economy is starting to go through the windshield, and he blames the Fed for a totally avoidable crisis. And what he means by that is instead of tapping on the brakes of the economy, they were going very fast, and now they're slamming on the brakes, and whoever's in the car is flying out through the windshield if they don't have their seatbelt on. And that's illustrated here in that the Fed is moving historically fast to tame inflation, meaning because they held off way too long. And so in other times, to get to a 3 percentage point move in the Fed funds rate, it took at least 12 months or 10 months, in some cases 24 months or 36 months in 2015. But here we have done it in about 5 months. And so this is what he means by slamming on the brakes and people going out through the windshield. And so they're saying credit market cracks start to appear as 3 companies sideline investment grade bond sales. So companies are putting off, even the investment grade companies are putting off bond sales because of the volatility in the bond market right now of what's going on. And here's corporate bond market distress indicator, and you see investment grade and high yield. High yield is not even as stressed as investment grade is right now. It's breaking away from the high yield. And so this kind of echoes what Jamie Dimon said from JP Morgan on Monday, that there will be a US recession next year and panic in credit markets that could lead to another 20% decline in the value of stocks. And he said, the likely place you're going to see more of a crack and maybe a little bit more of a panic is in credit markets. So guys, could these UK bond market problems spread to the US? Absolutely. And it seems like they already are. Not that we don't already have our own problems as well. And like you see, bonds are supposed to be the much safer, less volatile asset. And when you are even losing money in bonds, you sell the even more riskier stuff, which is stocks. So like I've been saying, I don't think we've seen capitulation in the stock market. So I wouldn't take any swing for the fences or go all in on some small dips in the market here and there. I think we have a lot lower to go before this thing bottoms out. And if you want to know more about how bonds work, especially in a rising interest rate environment, check out this next video.